How can you do global investing sitting in India? One of the companies in our portfolio is called IDEX, S&P 10 and S&P 490. The stock goes up, its market cap goes up, therefore its weight in the S&P 500 goes up.
What is a global compounding, which can push in a client's wealth creation journey, right? So if you can brief about the brains behind this, right? What is your research team? How big is that? So because it's, you'll be investing into US companies, would there be a team which would be sitting out of US, or you have the entire team in India? If you can throw some lights, it's again a new thing to us. So we thought probably we'll just pick your brains there.
Great question. We've been lucky to find a good team. Arindam Mandal heads the team. He's the fund manager. Arindam comes with a stellar academic pedigree. He was a topper at one of the best business schools in America, in Duke University. He was hired by Principal Global Investors, one of the world's largest asset management companies, out of campus. He started his career as an industrials analyst and later on became part of the global portfolio management team, where he's learned the tricks of the trade. He decided to join us 3.5 years ago, and he's done a phenomenal job in terms of delivering returns so far. He's been ably supported by Jaybir Singh Sethi, who joined us as head of research. Jaybir actually was very well known to Saurabh Rakshit and I through our days in Clear Capital. He later on went off to head research at Premji Invest. This is India's largest family office. And at Premji, he also looked after their global technology investments. Given technology is a big sector, Jaybir looks after that. Both of them have hired 3 other analysts who look after other sectors as well. And the team works really well because there's a lot of collaboration. There's a lot of cross-fertilization, because at the end of the day, insights for investing come from connecting the dots. And to that extent, a small team, a cohesive team, works beautifully well. You asked a very pertinent question. Sometimes we get asked this question very often. How can you do global investing sitting in India? Most of the team is based in India, between Bangalore and Mumbai. I reckon this would have been a valid question maybe 10 years ago. Right. First of all, like I said, this is a global portfolio. These companies might be listed in US, Canada, and Europe, but a lot of the underlying revenues actually comes from emerging markets from across the world. Right. Take, for example, a company in our portfolio is Hermes, which is one of the most premium luxury handbag makers. It's listed in France, but a lot of its incremental growth comes from China, Singapore, Dubai, and so on. So yeah, there's no locational advantage anymore for any investor, more so because of the emergence of certain technology platforms which provide expert networks. Remember, I said a large part of our research is primary research, which involves speaking to customers, suppliers, and so on. Now, you could argue, sitting here in Mumbai, how will you speak to a customer of a company listed or with operations in the US? Post-COVID, there has been mushrooming of platforms. One of the platforms we use is Tigis, which lists a whole host of industry experts across various sectors whom you can contact on the platform and get your insights through. For example, one of the companies in our portfolio is called IDEX, which make diagnostic kits for animals, for pets, dogs and cats, right? Now, we needed to speak to the customers. Who's the customers of these companies? They are veterinary doctors, right? Tigis provided a list of veterinary doctors in Houston, Miami, Kansas, and various places whom we could reach out to and try and understand, why do you prefer to use this diagnostic kit over their competition, right? And through that, we build insights. And through the emergence of technology and for a global investor, I don't think any particular locational provides any advantage, and we've been able to deliver the sort of returns we have sitting right here in India. And I'm pretty sure more and more global investors will emerge from India given the sheer amount of investing talent in India.
So, yeah, Pramod, very truly said, this is one question which one of our customer was asking us, someone sitting in India, how can you manage a portfolio outside India? But yes, we want to hear it from you. And we know, to an extent, we hear to a lot of con calls. Out of sitting in Chennai, you can, just, the timing is one thing, where we have to take into investors. And you briefed about your team and the product structure. So, in today's context, let's dive deep a bit more on US markets. So, US markets will be a predominant, structure in the portfolio holding. So, today the valuation, if you look at the valuation to an extent, the small and mid caps are much relatively cheaper in US, which is like, completely, different in India. So, where, the big seven contributes to the very large part of the, profitability on the S&P 500. And if you take Russell 2000, they are at almost, low valuation compared to the big seven of the large cap. So, how is the portfolio constructed here in, GCP? So, are you heavy on Max 7 or probably, are you like looking at pure value? If it is a value, probably it's going to be in small and mid cap. So, how do we see this? Probably if you can brief something on that.
No, absolutely. Like you said, the last few years, much of the returns have been driven by a handful of companies. Now, there is this S&P 10 and S&P 490. The 10 companies have driven much of the earnings growth as well as stock price returns, and justifiably so. Except, like I said, the market has rewarded these stocks. They're trading at multiples higher than the historical average. For all you know, they could sustain. But what we are saying is because of the emergence of passive investing, the passive investing, which is index funds, ETFs, which track an underlying index, it sort of creates a very concentrated market. Because take, for example, NVIDIA. NVIDIA reports very strong earnings, the stock goes up. Stock goes up, its market cap goes up, therefore its weight in the S&P 500 goes up. So an index fund which is tracking the S&P 500 buys more of NVIDIA, which itself pushes the stock up more and more. To that extent, there is inefficiency created. It began with very strong fundamentals of NVIDIA, but at 55 times earnings, I don't think it factors in any disruption risk. This inefficiency is also reflected in the rest of the market. Yes, the rest of the market haven't delivered the same sort of earnings growth as the Magnificent Seven, but that also means because of these passive investing phenomenon, their valuations are really cheap. At some stage, there will be mean reversion. I reckon the beginnings of this could be around the corner, because what Trump's policies are trying to do is trying to reindustrialize America, bring back manufacturing into America. It may not happen overnight, but there will be certain businesses which will benefit from this move. And given a lot of these businesses are trading at attractive valuations, there is a world beyond the Magnificent Seven. We are, as of now, in terms of GCP's positioning, 15 to 20% underweight on the Magnificent Seven. We do have some of the Magnificent Seven stocks, but not to this extent of the same weight as that of the S&P 500 or the NASDAQ. In fact, we are significantly overweight industrials. Industrials is almost 35-40% of the portfolio. So we actually complement those who have been heavily invested in technology. We're giving you an exposure which is not visible to you, because a lot of industrial stocks are B2B companies, names of which we may not have heard of as retail investors. And given our fund manager, Arindam, started his career as an industrials analyst, he's very good at that sector. And this is perhaps the best kept secret in America. The best performing sector in America, most people would think, is technology. I'm talking about long periods of time, 25, 30 years. Industrials actually has had a great track record in terms of delivering long-term returns. On the market cap basis as well, because of this passive investing phenomenon, a large part of the index is what they call as mega caps. In India, we don't have mega caps. We have large cap, mid cap, small cap. But in the US, you have mega caps, large caps, which are mega caps are $250 billion plus market cap stocks. If you look at mega caps and large caps, they're almost 85% of the index. We are significantly underweight in this segment, right? and we are significantly overweight on the small and mid-cap segment for exactly the reasons that you talked about. Valuations are significantly below historical averages even today. You talked about the Russell 2000, right? Whereas for the S&P 500, it is above mean. Some argue it is justifiably so because these businesses continue to generate a lot of cash flows. But hey, who knows? Because there is still a lot of hype around AI, some of which might be justified. But it's hard to see the $400 billion that the big four hyperscalers between Amazon, Microsoft, Google, and Meta, they're going to invest in GPU infrastructure. Hard to see how the ROI will come, given the use cases are still to emerge. There was this famous report from MIT a couple of weeks ago, which showed that 95% of companies which tried investing in AI have had no evidence of ROI on that. So I reckon AI, much like the internet, will take off eventually, but it could get worse before it gets better.
Got it. I think, we also strongly believe that, when there is a lot of noise around this space, I think it's better to be one step backward than a forward is what we were thinking. You have rightly said that, today everyone is index heavy investing in US. So definitely, an active allocation. So when I spoke to few large investors based out of US, they were saying, mostly the advisors, the big names there, who are the advisors, they just tell that, go passive, just have this is weights in S&P 500, you have this weight, and you have an emerging weight this much. So which are more static. So it makes a lot of sense. If at all, active can do well in US kind of a market also because of the skewedness which have been there. I can vaguely remember 2018, it was a similar scenario in India. When the money was coming in, probably, your Nifty was very, very expensive. And then your small cap was very cheap, right? So, Pramod, it's been a very interesting conversation on completely a different topic, or which is very new for the new age investors, right? So, we are like in the last part of the podcast. So, the last question, yes, definitely someone cannot throw a clear light on what it is, but this is something what an investor would require for. So what is a kind of a return someone can expect, and how GCP can strongly complement an India-centric portfolio? Say for example, a client is closer to $1 million, and probably if he wants to add a international investments to his portfolio, should he be investing into GCP, or what is the return expectation he can have when he comes into this product, and how this can complement his India portfolio?
Got it. So look, we launched the fund in October 2022. It's been 3 years now. For 3 years, GCP is compounded at 25% dollar terms compared to the S&P 500s at 20%. So it's a 5% alpha on a post-fee basis. Quite handsome in terms of absolute returns as well as relative returns. Having said that, I would like to caveat, we got lucky with the timing of the start of the fund. October 2022 was the bottom of that year's correction. If you remember, 2022, S&P 500 corrected by 25%, NASDAQ corrected by 35%. So leaving this aside, from a sustainable perspective, we'd like to measure ourselves on 5-year rolling returns. And the aim is to deliver about 15% dollar return. Remember, the S&P 500 compounds at 10% dollar terms long term. So if we do 15%, we would have justified our existence in some ways. So, and 15% dollar returns, assuming depreciation will be about 17-18% rupee returns, which is fairly at the higher end. You asked about $1 million investment. Remember, the LRS limit is $250,000. So for those who want to invest beyond this $250,000, they can take the OPI route. OPI stands for Overseas Portfolio Investors. So really ultra high net worth individuals who invest through corporate entities or partnerships entities can invest up to 50% of their net worth into a global fund domiciled out of Gift City. That way you can invest significantly larger sums than $250,000. And in terms of how does it fit in with your Indian portfolio, like I said, it is the low correlation, right? It's not just the returns. Not everything you invest is for the returns. It is the risk-adjusted returns. The low correlation allows significant risk reduction at the portfolio level without compromising on your long-term returns.
Thank you, Pramod. I know that was a very brief podcast. Thanks for coming all the way from Bombay. It's been very, very kind. When we reached you and when we spoke about, there had been a lot of action which is happening on the Gift City and the international investing. You guys were silently doing a great job. 25% compounding on dollar terms. It's really a great thing to do. And this will really, the idea of doing this podcast is to bring the great products and the great investment managers and to demystify more about their philosophy. That's the end thesis of this podcast, and that's how we have named Method to Madness. So mad people make great things, right? We strongly believe in that, and all the best from First Principles Assert. So thank you, Pramod.
Now, thank you so much for having me. It's been a pleasure. I thoroughly enjoyed the conversation with you, and my best wishes to First Principles. We at Marcellus are big fans of First Principles investing, First Principles thinking. So I really like your name, and I wish you and your team all the very best for the future.
Thank you for your kind words. Thank you.